Hello financial fans, welcome back to another stock analysis. Today we'll be covering HP Inc. stock ticker HPQ. HP is a printer and PC manufacturer known all around the world. Their market cap is currently sitting at $27.9 billion. In 2022 they generated a revenue of $62.1 billion, and the company split up in 2015 to HP Inc. and HP Enterprises. The dividend yield is currently 3.57%. The revenue can be broken down into two sectors: their PC systems and their printing. 68% of their revenue comes from the PCs, so the personal systems, and 32% from the revenue comes from printing, so printing devices, printers, and further supplies. The revenue by location comes 42% from the Americas, so North and South America, 34% from EMEA, which is Europe, Middle East, and Africa, and 24% comes from Asia Pacific, so Oceania and Asia. To determine the final valuation of HP, we'll be using a margin of safety at the end of our valuation. This margin of safety will be based on financial ratios, the health, and the growth of the company. Our standard margin of safety will be 25% and can either increase and decrease by the ratios that we're going to look at in just a moment. The amount that we'll be increasing the margin of safety with is determined by the scale that we see in the bottom. When we're using 4 colors in a scale, bright red will mean 5% increase to our margin of safety, orange will mean no change, bright green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT has slowly gone down over the past years, but from 2014 onwards it has slowly been going up steadily again. In 2014 from $4.4 billion to $5 billion in 2021. During this period, the average growth was almost 3%, which means no change in our margin of safety. The margin has for the most part stayed the same, with a few peaks and a few downfalls, looking at, for example, 2018 and 2019. But overall, it has gone from 7.25% in 2013 to almost 8% in 2021. During this period, the average growth was 6.47%, meaning a 5% deduction from our margin of safety. The next two ratios are the dividend growth and the payout ratio. We'll be looking at the dividend increases from 2015 onwards, since that's when the companies split apart and the dividends for both companies got pretty much cut in half. Dividend has slowly been going up from 35 cents a share annually in 2015 to 78 cents a share annually in 2021. During this period, the annual average dividend growth was 6.13%, meaning no change in the margin of safety. The payout ratio is sitting at a solid 33.2%, meaning that there's still room left for them to increase their dividend further. This means no change in our margin of safety. The last two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To determine the debt to EBITDA ratio, we'll be taking the debt, subtracting the cash from it, and then dividing it by the EBITDA. Out of this, we get the average years of EBITDA that it takes for the company to pay off all of their debts. In this case, it's 1.5 years, so 150% debt to EBITDA ratio, meaning no change in our margin of safety. The return on invested capital for HP is just under 14%, meaning a 5% deduction from our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of HP. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow from 2012 all the way to 2021. During this time, the average growth in cash flow was just under 3%. As we're calculating the lifetime expected growth in the cash flow, I've actually gone with minus 2%, seeing as a lot of the cash flow has been lost, a lot of the free cash flow has been lost throughout the years. It has managed to regain some of the cash flow going from 2015 to 2021, but I'm still projecting a slight downwards growth. With this minus 2%, we can determine the future free cash flow for HP, and then determine the terminal year of valuation using a perpetual growth rate of 2.5% and a discount rate of 9%. Doing this, we get a sum of free cash flow of $46.3 billion. To get our equity value, we have to add the cash and equivalents and subtract the debt. Doing this, we get an equity value of almost $55.2 billion. To get our discounted cash flow price per share, we just have to divide it by the shares outstanding, which is just under 1 billion shares at 982 million shares. Doing this, we get a discounted cash flow price at $56.20. With the current price of $28.36, our upside is $27.84, which is almost a 100% upside. The next model that we'll be using is the dividend discount model. I've imported the dividend payouts from 4 years ago all the way to the current year. During this time, the average growth rate in dividends was just under 16%. Since we're once again doing the lifetime expected growth rate in dividends, I'm going with 30% of the average growth rate, which is 4.8%. In this valuation model, we'll also once again be using a discount rate of 8.5%. Doing this, we get a dividend discount model price per share of $28.31. This is very close to the current price of $28.36, and our downside is only 5 cents, which is 0.17% downside. The last model that we'll be using is the multiple valuation. By looking at similar companies to HP, looking at their stock price and their earnings per share, we get an average PE multiple in the industry. In this case, the average PE is 12.63. To get our fair value then, we just have to multiply it by the earnings per share that HP is generating. This is $3.05. Then we get our fair value of $38.52. With the current price of once again $28.36, our upside here is $10.16, which is almost a 36% upside. Let's look at the final overview of our valuation model next. Looking at our final overview, we have imported the discounted cash flow price per share, the discounted dividend price per share, and the multiple valuation price per share. Out of this, we get the average price of $41.01. We'll be using the margin of safety that we calculated earlier by using the standard margin of safety of 25%, deducting 5% for the margin growth, and deducting another 5% from the return on invested capital. Doing this, we get a margin of safety of 15%, leaving our fair value at $34.86. With the current price of $28.36, our upside is almost 23%. So, based on my calculations, this stock is a buy. I hope you enjoyed this video. If there's any other companies that you would like to see me cover, please let me know in the comments. Thanks for watching.